Guys, hello and welcome to episode 40, or as the new in Roman numerals, episode XL. And I think today is a very special episode. We started this experiment called the Money Talks exactly 1 year to this date, and so much has been achieved. This is, like I said, the 40th episode. So we've had a number of entrepreneurs, some amazing investors, some amazing stories that have been talked and we've had a chance to live through the challenges and through the successes of people that have been there, done that, endured, and have been super successful. We've heard failure stories, we've heard success stories, and I think today is a very important day because also my first attempt at running a fund, we completed and we got oversubscribed. We ended up raising 225 crores for our first fund, and we now have the ability to support 40 early stage companies. We'll have the ability to as long as they perform, we take invest up to 15 to 18 crores into these companies. And I think I like I said, I don't think there could have been a better day where we had both events, the 1 year anniversary of the Money Talks and the final close of our fund. So what we've been contemplating internally was there are so many lessons learned, because this was one of the most difficult, I think, fundraisers. I've fundraised for startups before, but raising money for myself was definitely a very interesting experience, especially because I went through two bouts of COVID-led lockdowns. We had a massive meltdown in the markets last year, as you remember. I've had personal challenges, professional challenges. We've had, we have seen everything, forward and in between. And I thought, for today, as a venturepreneur, as a founder, I could share my experiences, and many of you guys who are out there fundraising, I could take questions from you guys. I know none of our episodes on the Money Talks really talk about fundraising, so the team and I thought that this was probably a very good time to talk about fundraising strategies, how to fundraise, when to reach out, what are the kind of different things that people could do when they're fundraising. So like I said, today it's an open episode, guys. This is an episode for everyone that has been tuning in for so many months, and for, like I said, the 40th episode. So if you have any questions about fundraising, and strategies, how to approach somebody, how to create a long list, what is the kind of presentation someone should have, how long should it be, I'll be really happy to answer those questions today. And looking forward to having you guys again. We're going to have these episodes continuing, and today we have 40, and someday we'll have 100, and someday we'll have 400. And my commitment to you is to keep bringing in some interesting people, interesting guests, and taking their stories to you, so that all of us as founders can learn something, and we can take it take something from each one's journey and make add it to ours, right? So it's better to learn from the mistakes of others than make all the mistakes yourself. So guys, like I said, anybody have any question, please put them in the comment section. I will be happy to answer them. And the topic for the day, once again, is about fundraising. So if you have any question about fundraising and the strategies, today is the day. Go on ahead, and we'll wait for some questions to come in. And by the way, thank you so much. Donna DeBroy, Faisal Siddiqui, Vardhan Gandhi, Prakash Nikam, Bhavya Kaushik, Rashmi Surana, and Jashank. All of you guys, thank you so much for your kind wishes. And really, the credit goes to the team. I was just telling just before this call, we had a quick moment with the team. Just all of us who've been part of this journey got together and discussed the strategies and not just strategy, the journey actually of where we started. And we remember the first LP that we signed up, and we now remember the last LP that we signed up, and everybody in between. So I think we've got a first question already. We got Manoj Sharma. He asked, do we have to create a prototype of fundraising? Manoj, so here's the thing. It's much more difficult to raise something when it's a blind blind thing that you're probably selling, right? Like if you don't actually have a prototype, it's all on paper, right? It's much difficult to sell a paper idea than actually having somebody who can touch and feel and see the service or experience the service or product. So obviously it's not like you can't fundraise, but if you're trying to raise and unless you've got a strong history of execution, uh, you know um, I would definitely say that the prototype is extremely important. I think, especially as you raise the later rounds, as you start going towards your seed or seed plus or those kind of rounds, you definitely need to have a prototype. But if you're actually raising without a prototype, you're typically looking at you know pre-seed or ideation stage funds, which are usually your accelerators like 100x VC or even you'll have incubators that sit inside most universities like NSRCEL or CIE Ahmedabad, places like that. So I'll take the next question, which is from Vardhan Gandhi. What should be the exact time of the fundraise? Does the team size really matter to the investor? So again, depends upon what kind of fundraise you're going for, right? If you're trying to raise a pre-seed kind of a round, then obviously you go after the investors that actually invest into those kind of structures, and they usually at every stage, there's a different thing that investors are looking at. Right? At pre-seed, usually the investor will be looking at the team, whether they have the experience, can they execute, and they'll be looking a bit at the space, right? And as you go ahead, the metrics start to expand, right? Like at seed plus, we'd be looking at, okay, how much revenues do you have, right? And what kind of revenues are these? Are you actually are you getting the revenues from the target market that you're talking about? So, and then as you get to Series A, then your metrics change towards, okay, how big is the market? You've got revenues, you've got traction, but how big is the market? And how well are you executing? What's your ranking in the space? And I think at every stage, like I said, your ability to what you're trying to convince for changes, right? So again, it depends about again which stage you're going for to time your fundraise. But I usually would say that you should probably be raising at least at a time when you've got 6 to 9 months of capital left, because fundraising can take some time. And if you're going to raise right at the end, right at the edge, it usually does not work out well, right? If you're running out of cash and you're trying to keep the lights on while trying to convince you're going to build a world-class company, probably not the best idea. So give yourself 6 to 9 months, at 9 months being obviously the preferred timeline, but at least 6 months is required from the time you begin a fundraise to you convince an investor. It takes a couple of months to do that, couple of months to get the due diligence and stuff done, in case you have any due diligence issues because some certain compliances weren't met, then take another month or so and you've got a month buffer, right? So that's probably a good enough timeline to be fundraising. So Jashank, I think there's a great book, and I think I recommend that to anybody who's in sales to read it. It's called How I Raised Myself from Failure to Success in Selling, written by a guy called Frank Pettiger, and I think it has some amazing insights that you should about the art of follow-up. So usually what it says is that, again, if you're cold calling, right, to get an answer from somebody, it probably takes about 3 to 4 kind of follow-ups before you get an answer, right? So usually if you're sending, let's say, cold emails to someone, or if you're cold calling someone on the phone, you should be calling them at least 4 to 5 times, because it takes about that many touches before you'll actually get through. But once you've got into the sale, right, then you need to start deciding that usually the more meetings you take, the lesser your chances of closing, right? It's almost inversely proportional. The more touches you have with the customer, the lesser your chance of closing them. And this is, I've seen this in my sales career for a long time, and since fundraising is a medium of sale, it definitely applies here as well. So what I would say is that if you're looking at once you've got into the deal, once you've got an investor and he's interested, you need to probably count the number of times you're touching that investor, right? And if with every subsequent touch, if you're not making positive progress, if it's just stuck at the same place, you're probably losing that customer in the first place. So there is a correlation there. So keep it limited. But remember, when you're cold calling, if you're reaching out to an investor for the first time, probably take 4 or 5 emails before you get a response, right? So it's more touches initially until you get a response, and once you get a response, try to close the deal as quickly as you can, right? At least move on to the stage where you have a term sheet, right? The longer you take, or the more number of meetings you take to get to a term sheet, it usually means that you're probably going the opposite side where you want to go. Let's see. Again, Sumit, I've answered the question. I think usually in seed rounds, you need to have some bit of traction before you get a seed round. Usually, the round you would be raising would be like an accelerator or an incubator round. So let's see. Yes, definitely. I think you must remember that funds are not actually owned by the fund manager. They're usually kept in a third party trust. So the fund manager is usually some like an advisor to the fund trust. So therefore and the investors in the fund expect a much higher degree of compliance, and that the rules are getting followed, because again, they're expecting this fund manager to do their job. So funds traditionally will take longer to invest in a startup than an individual, right? So if I when I could write a check tomorrow, right, into a startup, but because I don't have, well, I might have my own processes, but I'm not bound by them, right? But as a fund, I'm getting audited every year. Every single step that I do has to be documented. SEBI's even put in additional rules earlier this year, in which even the due diligence, the reports have to be discussed, they have to be minuted. If the due diligence is done, but nobody has paid, or we have not paid attention to the risks laid out, it could come back to bite us. So all of these things make it obviously a lot more there's a lot more compliance measures, there's a lot more steps in a fund to ensure compliance, because again, we're not investing our capital. It's not like the money's in my bank account and I can just write a check and we're done, right? The money's in the trustee's bank account. I have to get the trustee's approval, and therefore it takes a bit longer. So you must, like I was talking about this earlier, at least allocate 6 to 9 months before you start raising a round, or 6 to 9 months of runway should be there when you're raising a round, right? If you're getting towards lesser than that, then you're really cutting it short. You don't have enough time for a buffer. It'll take you at least 2 months, 3 or 4 meetings to get from initial meeting to a term sheet, and then from a term sheet to an IC approval to due diligence, and then obviously the SHAs and all that. All this process takes time, and therefore, if you're raising a round, have enough time, have enough buffer. Don't be in a situation where, because you're running out of cash, your numbers start plummeting, and once that happens, then the investor also gets, someone like us would get very jittery, right? And in our own fundraise for this fund, what really helped was that we were able to consistently keep investing and keep showing growth within our investee company, so that when new investors were coming in, they could see that there was a running portfolio doing well, and every month they were delayed, the portfolio was just doing better and better. So it created its own level of FOMO towards the end, right? And that really helped us at the end of the day. Can solopreneurs raise pre-seed funding? Yes, definitely. I think the investors today are getting a lot more comfortable with the idea of individual or single founders, but it's still, India is a very difficult place because of our ecosystems, right? To have a single founder becomes a bit difficult, because not every, just fundraising itself can take a lot of energy out of the founder, right? A lot of time and effort is required for fundraising, and so sometimes I feel that at least having a good co-founder, one person could focus and look after the business while the other person is fundraising. But if one person is doing both things, it can be a lot of pressure, right? I mean, what really helped there is I had people like Sanjay and Vinod and Sandesha and Jashank, Gauri, all of these guys who could take control of the steering wheel while I was running around raising money, right? And it's a lot of effort, right? Because it takes a lot of effort. It takes out a lot of your energy. If I was doing everything, I don't think we would have been able to make 12 investments, or we would have missed out on hitting the number that we wanted to hit. So yeah, you gotta have both things. You probably need to have a co-founder in India to, if you want to really go out there and do well. And most Indian unicorns, you'll see that at some point even if there was a solo founder, they've either brought in somebody or they built a really good strong second team. Let's see. Yes, definitely, Jyotishna. I think raising money for a venture fund is, I think, I mean, and you can ask any of the VCs out there, it's probably 100 times more difficult to raise money for a VC fund than it is to raise for a startup. And the reason for that is that it's very easy to explain what a startup does. It's very difficult to explain what a fund is going to do. It's like the questions that we're getting asked, where we're saying that we have an idea of how to invest, but there's no actual investment that is in the fund at the time that we're doing our fundraising. So it becomes a problem of them having to trust the fact that we're going to execute as per the promises that we've made. And it's almost like raising. It's almost, imagine you're raising a Series E round, so you're raising 200, or Series D round, or a C round for that matter, and you have no product, right? You just have an idea. So can you imagine how difficult that would be? I think that's how difficult this is. Like, it's like raising 250 crores and saying, okay, I'm going to be, I don't, I mean, I'm conceptually this is what I'm going to do, but I actually have no proof that I'm actually doing that. So you have to trust what I'm saying, and why should they trust you? So it's much more difficult. It's much more difficult, much more yeah, infinitely more difficult. Any VC is going to tell you that. I see couple. Uh, Thankfully, I've been in sales, right? So couple, I think, was a little easier for me. I've been out there selling for the better part of, I think, 16, 17 years now. So presenting came to me, but I had not presented in a long while until I started fundraising. Right? I'd always taken presentation as an investor. So it was definitely, it took some time to hit my stride, to understand the kind of tonality, the kind of uh, information that I need to impart. But I think once I got the knack, it was actually kind of fun. I actually enjoyed fundraising, and I mean, I ended up hiring a couple of people, and being able to train them, and that just brought me back, 10 years ago, when I was doing the exact same thing when running my startup in the energy space. Being able to train other people because I knew how to sell, and I think it was definitely fun. I'm sure it's uh, and like I said, it's very different, because now you're the one answering questions, you're the one having to explain, show data, show what you're doing, and when you're on the other side, you're, especially when you're an angel, there's no one to explain things to, right? I mean, except for my dad at the dinner table, which is my daily, icy call. But yeah, it is definitely very difficult. So this is a great question. Why invest in startups with no surety of even ROI and wait for 5 years when you can make 20% per annum in stocks? It's a great example, but it's a misnomer as well. You're making it sound like each and every stock forever just gives 20% annually and never goes up and down. Ask people in 2009, people, when you see multi years of returns getting wiped out overnight. Uh, Public markets have become very fickle, right? They're stable if you think about, if you're able to get through all the volatility. They're much more volatile. Last year, if you remember, when COVID first hit us, global markets, wiped out a decade of gains in less than weeks, right? But private markets stayed extremely because most private markets are funded for 18 months, right? So it wasn't like overnight you're seeing these businesses get wiped out. We were, as a private investor, I was able to with my portfolio, save the portfolio, help them redo their budgets, and within a year we were 3 times in terms of revenues. All our companies combined were 3 times higher than what they were pre-COVID, and most of them did not need to raise any further money. I think maybe altogether they must have raised an additional 2-3 crore rupees to just survive one of the worst economic hits in a decade, right? And now imagine the kind of volatility the stock market showed. It first fell, then it skyrocketed. If you got caught on the wrong end of either one of these cycles, you could have seen 10 years worth of gains just getting wiped out. So it's not 20% just, you know, you look at it between 2010 to 2021. Yes, you'll see that it's like this, uh, you know, line that's just going consistently up. But if you start expanding that, you'll see it's more like, it just kind of does. The stock market has its own ups and downs, and if you get caught on the wrong side of it, the ROI you're talking about may not be possible. I mean, imagine if you were an investor in 2008 when the stock market was at an all-time high. and it would have taken you 5 or 6 years just to recover your principal, right? And if you got stuck in the wrong stock, you probably just get a complete wipeout. So it's not the same. What I will tell you though is that startups have, especially the Indian startups, have the ability to probably beat the stock market returns if you're investing wisely, if you're investing, um, if you're paying attention, and if you're spending enough time with your portfolio, for doing enough due diligence. Indian startups, Indians founders have the ability to beat the stock market returns as a portfolio by at least 2.5 to 3x. And I can tell you that from my own personal experience. I can tell you that because I have had to compete with the stock market portfolio that my family runs for the last 10 years, and I think my ability to get capital out of them and move it into the private strategy is probably the biggest testament that we are definitely being able to beat their returns. Uh, and they've been doing well. So it's not like they're still growing at a pretty fantastic rate, but we're able to snatch some capital away and keep pumping it in over here. Yes, Bikash, I think your question is very relevant. It is necessary is it necessary for the founder to work full time to raise the fund, even if the founder is successfully building the product and ready for market? Absolutely, because it's the same thing when you've got your product ready and uh, built out and ready for the market. You still have to go out there and sell it, right? Just because you open up a shop doesn't mean that people are going to come and buy. Like, you still need to market it, you still need to reach out to your target audience, you still need to do a lot of things to be able to attract your target, to be able to get people into your store so they can buy. Now, so similarly, when you're selling shares of your company, right, you're selling a part of your company, you're selling a part of your dream, you will have to go out there and present to investors. And that, like I said, in India can be a pretty the fundraising itself is not as challenging as the processes that are required after the fundraising to get the money in and to be able to uh, issue the shares. It's a pretty decently intense process, and I think that's why it requires somebody almost there full time who is taking care of it. I mean, otherwise you just spend your time fundraising and no one's going to look after the business unless you've got a really good second team that is going to take care of things for you. Pravas Chandragiri, what milestones does an entrepreneur need to hit after raising each round of capital? I think in each round of capital before you raise, and I get this from the Peter Thiel book, Zero to One, talks about the before each round of raise, you need to think about what is the one question that everybody needs me to answer about my business, right? So it could be scale, it could be profitability, it could be XYZ, whatever that thing is. Whatever you're raising for, if that whatever that most critical question is, maybe one or maybe two, those are the two questions you need to answer before the next raise. Because then once you've answered those questions, then the next set of questions will come in. So if the question is, okay, that is this space big enough, and that's the question, and whether you can scale in that question, whether you can scale up to a certain size, then you should be focusing just on answering that question through the medium of growing your business. And for that to happen, whatever money you need, you might require, some people might require a few crore, you might require tens of crores, but you raise that money with the sole intention that this is what I'm going to prove, and this is how much money I need for it. And then you go out there and prove it, and as you prove that, you'll have some new questions, right? And hopefully, if you don't require capital, don't go out and raise it. But if you require capital, then you obviously need to figure out what are the next one or two questions that I need to answer, and then go out and again raise money to answer those two questions. And as you keep doing that, you'll get into the habit of obviously answering questions, and more investors backing what you're doing. And hopefully one day will come where you don't require their capital. I think that should probably be the goal of every entrepreneur, that someday my business becomes self-sustaining, and I don't require outside support because my customers are willing to pay for my growth and operations versus my investors. I think once that happens, obviously you won't be raising anymore. But until then, keep answering the questions that are most important. That's what's the most top one or two critical questions that every single person is doubting about my business. So let me go prove that with this current round of raise. Let's see. We've got. Thank you guys. By the way, there's a bunch of questions. I'm trying to get through them as quickly as I can. So Raja RK asks, is there a possibility of raising growth rounds for scaling non-startup, non-tech, and non-high-tech businesses that are doing well? Absolutely. I think there's a misnomer that all startup investments are high-tech, or have technology behind them, or they have to be some tech-led business out there. No, they don't. I think many of the startups getting funded actually have a real business that is probably utilizing technology to catalyze or to speed things up for them. So in your case, no, there's many funds that do not worry about the technology, whether you're a technology leader. They worry about how are you capturing your market and what kind of unit economics and things like that, and the kind of growth parameters you have. And yes, there are many investors like that in the market. You can definitely approach them, and you can definitely raise lots and lots of money, even for non-tech, or like you said, non-tech, non-high-tech businesses. No, Rishikesh, I think educational background can only get you so far. I think it probably just gives you a couple of, it gets you a couple of steps up ahead on the ladder, depending upon if you graduated from an Ivy League or a IIT or a IIM. But none of these credentials can solve the growth problem, right? I mean, a business is a business. I mean, many of the people that are currently the richest people in the world, they don't even have a college degree. So there's no thumb rule that you have to have a particular amount of educational background before you get funded. It's definitely maybe just gets you in the door. Certain funds or certain investors look into that kind of stuff. But I was just reading some report recently about the classification of Indian unicorn founders, and I think almost a fifth of them don't have a college degree, or don't have a like a top college degree out there, and 1 out of 5 unicorn holders, it comes from that background. So it tells you something. Vimal Panjwani asks, any suggestions on strategy for fundraising for an agri-tech plus social impact startup, angel investor, or VC for the first round? I think not sure whether it can you segregate the agri-tech and the social impact, or do they have to go together? Because the thing is that there are very limited number of social impact investors in India, especially as angels, and even lesser as VC funds. And then if you're going with agri-tech, which is has another very small subset, it's not a mainstream investment strategy for many people. So you're really limiting the number of people by saying I am agri-tech plus social impact. You may want to choose one of them. Social impact could be a externality, but if that is one of the focuses, then you've got a very limited number of investors you can reach out to. And I would then start with the social impact investors, then see which one of them is okay with agri-tech. But don't start with the agri-tech guys, because not all agri-tech funds are social impact funds. So, but most social impact funds could be agri-tech funds. So probably start from the social impact side of things. There are certain angel investors I can talk about, like a Nagarajan Naga from who also is very closely associated with NSRCEL. I think somebody you could approach. He's very, very strong at agri-tech. Definitely, and does a bit of impact as well. So definitely someone you could approach. But like I said, very small subset. When you're going agri-tech plus social impact, the subset probably becomes very, very small compared to the entire universe out there. I think if you look at the last 30 months of the Indian startup ecosystem, I would say almost 95% of Indian exits, Indian liquidity from private investments have come in the last 30 months. And therefore, I'm super confident that Indian LPs are already making, and will be making, lots and lots of money. Recently there was a transaction in which Ivy Cap, Vikram's fund, with a single exit, returned more money than they had invested, than they had raised from all investors with a single exit, and that too was a partial exit in purple. And can you imagine every other investment that he's done in that fund from there on is only going to generate profits, right? Because he's already repaid the investments made. Another great guy is Nikhil, right? Look at Nikhil's 6 Cents fund. He's twice. He's on his third fund now. I think with the first 2 funds have returned capital back in less than 2 years, each one of them. So you definitely have the ability in India to create some serious alpha returns, even dollar adjusted. I think we can definitely beat most markets around the world, and that's just because the the strength of this internet economy, how massive we've become, and the fact that the entire country is online. We have some serious numbers, and I think that has really created the kind of market which is very lucrative for global investors, and they're coming in and they're investing here. Many Indian corporates have realized if they want to chase growth, it's not going to come by just keep on growing their own businesses. They've become very open to acquiring businesses like the Tatas or Reliance, or even investing in other businesses, and being strategically aligned. And these are some really good signs, because there's so much acquisition capital available in the market, which means that even if you build a decent company and you're invested in that, even a decent company could see a pretty decent exit for investors. I have probably 7 or 8 companies where we made anywhere between 5 and 10x on those companies in less than 3 years, right? And because of that, the IRRs are very high, because those kind of exits have reduced the principal that was invested, and then we can continue to hold on to companies like a Kootloot or a Karza, or an Agnikul. Bhaskar asks that apart from different seed fund series, DCF products, and other metrics, etc., what attributes have you found to be a good trait in startup founders which make things click? First of all, I don't believe in DCF to evaluate startups. I think it's the worst tool that anyone has ever used since the dawn of Excel, to evaluate a startup. It's definitely a great tool when you're evaluating companies which have much more stable cash flows, but startups inherently are supposed to not be very stable. So you're utilizing the wrong tool for the wrong problem. But I have always found that startup founders that are maybe have experience in the area that they're trying to operate in, right? Having passion for that area. Like I have realized that, especially in food, right? This is very, very that if one of the founders is not passionate about the end product, then the end product usually is not good enough to build a scalable product on, right? So if you're running a food tech venture and you don't have at least one person who's fanatic about the food, who actually loves food, right? You're not going to have an end product that you can scale. And therefore, I think one person has to be that kind of a fanatic, or kind of a really passionate person about the whole product. And I think that definitely is a very important metric. Another thing I think that has definitely stood out for me is that when founders start worrying too much about dilution, right, or they want to consistently just keep fundraising just because you know because they can. I think those kind of founders I found eventually do not make it, right? Because what they're in business for is for the wrong reasons, right? You're not in business to raise money. You're in business to do business, and raising money is just one of the tools to help you do that. And when founders don't have that very clear, when they're only in the business because they like to raise money and they can, you know, get their names in the papers and they can write things on Twitter and people will comment on it. I think it definitely puts them. It definitely has the wrong priorities in place. So don't be raising money just because you can raise. I think you raise money because you're very passionate about something you want to solve, and for that you need the capital, and you're willing to impart some part of your company for that. And what you're really more concerned about is solving the problem and being able to make it really, really big. I have been investing in Israel personally for a while, and I'm telling you, some of their rounds, there are founders diluting 35-40% very early, and this is very, very common in Israel, where a single round could see 30-35% dilution for a single founder, but they're raising enough money to make sure they can solve the problem. Their whole point is that if I solve the problem, the company is going to be big enough that even if I own 15% of a $1 billion company, I'll have more money than I'll ever spend, right? So the point is to get to that, to solve the problem and become massive, and not to focus on the dilution and then try to in some way or the other um, save the equity. There's nothing to save, right? This equity was worth nothing if you don't solve the problem you set out to be. So what are you really saving, right? Go out there and make some value. Go out there and get that product working, and you like Mark Cuban said, it's better to own 10% of a watermelon than 80% of a grape. So just keep remembering that. So let's see. So this is a good question. that says, how do you see the next 5 years? More weightage coming towards innovations or acquisitions, as it's not the same time as it was 5 years back. I think this is India's going to be, and it has been. If I look at the numbers, we've been growing our M&As. Like I think we're growing at some pretty crazy rate. I think it's 30 or 40% year on year for the last 4 or 5 years, and that's simply because many Indian corporates, both small, medium, and large, are now interested in acquiring startups. They're actually interested in adding startups to help with their growth, and this was not available 5 years ago. This was Indian corporates pretty much stayed outside the market, so they waited. The kind of terms they offered would not be acceptable to an investor, or would not be acceptable to a founder. And I think that attitude has definitely changed, and many, like as our own fund has seen over 20 listed companies coming in directly or indirectly, uh, and it definitely signifies a major shift in in their outlook. And I think that's very, very positive for the Indian ecosystem, because these guys can really change the trajectory of a company. I mean, recently, Nagnikul, Mr. Anand Mahindra wrote $1 million check, and his ability to connect, his ability to network, and his name will definitely take the company very, very far, right? So definitely, I would say an interesting thing that M&A is going to be big, and I think Indian corporates are going to participate even more and more in the Indian startup ecosystem. How do you source for investment ideas? Is there too much competition? And how do you make sure you source the next Amazon before some other VC does? So we have a very good network of founders and people that I've co-invested with in the past. So we source all our deals only through referrals. Many of you guys, if you have ever applied to any one of us in the team, we always usually take you back to a post I wrote 2 or 3 years ago, where 6 ways to reach out to us. And we've just realized that it's probably better to trust the network that you've built, and keep focusing and building your network, so that people can the people that come to you are people that are referenced, people that come from somebody else who has taken a look at them, and somebody else who understands you, so that you're not wasting the time on ventures that do not meet the investment criteria that you have. And I think that nobody would know that better than either the founders in which we've invested into in the past, or are people that have invested or co-invested with us in the past. And I think that's what we've relied on for our deal flow. Never really focused on creating a unicorn, so it's not part of my strategy to say, oh, I'm going to invest only in unicorns. I have always liked to invest in great businesses that are solving a real human problem and that can scale. Right, where that scale takes us, only scale will tell. I never thought that Oyo would become a decacorn. I never thought Purple would become a unicorn, or right now half a unicorn, or Tala would go where it's at. But these things are not in your control. Startups pivot too much to say, that I can literally tell you that, yeah, this guy's going to be a unicorn. They just pivot way too much. It's just way too uncertain. You just focus on doing the right things, and when the opportunity presents itself, magic will happen. Lalit Iswani asked that, hi, what are the common mistakes that startups are making from your experience? Things I need to avoid when I'm starting up. I think the most common thing is that they've is waiting to launch, right? I think startups founders always keep waiting for that product to be perfect to launch it, right? Or that perfect moment to come, or when I've raised the money, then only then I'll launch the product. It's just incorrect. I think it's and I get this from the lean startup methodology, right? I mean, you need to get your prototype out to market as quickly as possible. You need to get real feedback, take that feedback, improve your product, and keep going through that feedback loop again and again. And a very important point here is that do not create a feedback loop in which you're offering stuff for free, because free का कोई value नहीं है, right? In India, especially in India, it's very difficult to go from a free product to start charging for it. So try, and I would again come back and remind you that whatever product or service you're making, there obviously is a real problem you're solving, and whatever problem you're solving, that person is willing to should be willing to compensate you for that problem that you've solved. So in that case, shouldn't that person be paying you something? You know, And time and again, you have to create a compelling enough argument that people are willing to pay for. If you can't do that, then what's the business, right? Are you going to keep selling stuff for free and then keep who's going to pay the cost? Who's going to pay the piper at the end of the time, at the end of the month? And if you're not going to not be able to charge people, then there's not really a viable business out there, because I've never seen a business with zero revenues and making a profit. So, I think as a startup founder, the first thing to do is that you make sure you launch your product as quickly as you can. It doesn't have to look good. It doesn't have to look sexy. It doesn't have to look perfect. Even imperfect products that you launch, but you need to have enough learning. You need to create enough feedback loops to come back and learn and iterate and come out with the next iteration, and keep doing that again and again, and make sure you charge for whatever you're doing. Right? Don't offer stuff for free. Right? They need to pay in some way or the other. The investment thesis for us is to invest in companies that have about 7 to 10 lakhs a month in revenue, that can utilize our capital and our network and experience to scale. We're looking for businesses that can do four simple things very, very clearly. The four principles that we think of our investment strategy is that they should solve a real human problem. They should have positive unit economics that can scale. They should be utilizing technology as an enabler, and they need to be run by founders that have experience, right, and skin in the game. So those are the four things, and that's how we evaluate every company. The way we generate the returns, obviously, is we invest in companies, put in a 2 crore check, our average check at seed plus, as you call it, and then from there we keep doubling down on the winning company. So 2 becomes 4, 4 becomes 8. So as this company grows, our check in the company keeps growing, and our intent is obviously when we exit, we'll have enough equity held in the company that we can make a sizable return for our for our investors. So that's what we do, and that's how we invest. How can someone reach out, Hamraj? The easiest way for someone to reach out to me is to find a reference, find somebody that knows me. There is about 100 and I think 250 founders whose startups I have invested in. And so it'd be very easy. Just go to any one of our websites, artha.vc, artha.ventures, find the name of the founder, convince the founder that you have a viable enough business plan, and that you'd like a reference to me. And as long as they reference you to me, I'll be willing to look at your business plan. Ankur asks, and Ankur, I know you've been there with me since the first episode, so thank you so much. It's 1 year and 40 episodes in. And your question, the Ankur asks, let's ask you your rapid fire question. For you, what works? Scalability before profit or profit before scalability? So let me first define what I mean by profit, so that this answer makes a bit more sense. I think that startups should have positive unit economics. So they should be making a profit per transaction. On an overall level, obviously, as a company, you may still be burning money, but at least on a per transaction level, you cannot be burning money, right? So you might do that right at the start when you're doing pre-seed or early seed kind of stuff, where you're just trying to figure out your market. You may still be selling a little bit below your cost, so you may not be, your unit economics may be negative. But as you grow, the company cannot consistently, sell things below cost, right? Because there's no way to create value for your company if you continue to sell below cost. Now, therefore, for me, I've always believed that a company needs to achieve profitability before again going for a round of scalability, right? And you don't start scaling until you're very clear that you can deliver positive unit economics. Because if your unit economics are negative and you're scaling, which means every sale you make only adds to the loss, right? And that's not a situation. That's not the way businesses are run. It doesn't matter which era we live in. The mathematics is never going to change, right? Selling price minus cost price is equal to gross profit or equal to profit. And so there is no way to take a gross loss company and make it into a net profit company, right? There's just no way to do it. So just be careful. I always believe that you should first, during figure out your unit economics, and then figure out then start scaling, not the other way around. So at least when I evaluate a business, I'm always like, listen, are you positive at a unit economic level? Then we'll figure out the scale, because throwing gasoline on something and making it grow is the easiest thing. I know I'm saying it, and it sounds very, very, bravado kind of to say it, but I have never seen a startup have as much issue at scale as they've had at delivering positive unit economics. right? Delivering positive unit economics is far more difficult than scaling. Scaling is the easier part. There are many books and many people who can help you with scale, but there's definitely not easy for you to deliver a profit, and therefore it's always profitability before scaling, and not the other way around. By the way, guys, Mr. Damani is my father. Please call me AD or Anirudh. More than happy to leave the Misters and Sirs for my father. One message which helped you build your career to what it has become today. First thing that comes to your mind, I think, just take risk, right? Take risk. I think I I left my I had got out of college with two, maybe three job offers at the time, and I took the job offer of being a door-to-door salesman, right? And I just thought that it was going to teach me something. It would teach me how to convince people, and that would come handy sometime in life. And I think earlier on in your career, be a lot. If you experiment enough, you know exactly what is exactly where you're going to find your niche, right? What you're going to really going to be good at. And I think I just took that risk. Then I took a risk of setting up a commercial division, you know, as a 22-year-old at that time. Then I took another decision to, become an entrepreneur at the age of 26, 27. We pulled in every single penny that we had ever made to buy out the business and running it. So we just, I think you just consistently take risk, becoming an angel investor, starting this fund, probably one of the biggest financial risks I've ever taken. And I'm really grateful that it's paid off, or is paying off. Rather, it hasn't yet paid off, but I think it's you keep taking risk, and don't take the easy. You don't take the safer path. It's not about take the easier path, but don't take the safer path, because safe does not always mean that it's the right thing, right? So at least for me, I've always liked, like I said, taking risk, and take enough risks in life, you learn a lot of things, and the point is that by the time you're 40, you would have learned enough that you know exactly what you want to build for the next 20 years, which you're going to. And 40 to 60 is usually the best wealth making years for yourself. So by that time, you should have enough experiences built in, so that you don't you're really building your wealth between the ages of 40 to 60. So burn rate for me would obviously be the net. If I obviously gross profit is just taking care of cogs, right? But when you start talking about the investments you have to make towards growth, right, towards hiring a team, and the kind of expenses required for opening up offices, obviously all of these things take money, and usually companies would be burning capital for a bit of time before they can start becoming positive. So I'm not talking about companies that have a net profit, but I'm talking about companies that would have a gross profit, right? And usually a gross profit on every sale. I think those are the kind of companies that I like to invest. So hopefully that I've cleared that confusion for you. Guys, I'll take a couple more questions and then call it a night. I know that it is a Friday night, and most of you guys have some celebrations going on, or some dinners to attend. So let's see. This is a great question, Pravas. Pravas asked that what are some tips for entrepreneurs on how to evaluate their potential investors? First of all, I think always and always and always research your investor, right? Before you speak to an investor, make sure you've gone through their. And the good thing is, in today's internet world, you have enough wealth of information available if you just spend a little bit of time, right? So even when I was talking to an LP, I would spend my time going through their LinkedIn. I would spend my time, if they had an open Facebook profile, going through that. If they were mentioned in the media, put together a single page document on them, so that when I'm talking to them, I'm trying to find, number one, have they done the kind of investments that I'm talking about, right? And I would also try to find commonalities, right? Where can I quickly connect with this person? Because many of the time I'm meeting this person for the first time, and I need to build bridges of trust. So for that to happen, find common areas, right? And you won't know that if you're, and this is just so surprising to me, that how many founders reach out to me and they do not know what we've done, what we've invested in, right? Very, like, I would say out of 20 founders, probably one knows us well enough to where I feel that they've done their homework on us, right? They're prepared for us, right? They would, and it's a very easy thing. I mean, I write a blog, and I pretty much share all the things I need to share. I run a show. I quoted in the media. My team is quoted in the media. So you know how we think, right? It's not rocket science, what we're looking for. But if you haven't done your homework and you're just coming in blind, chances are you're going to get shot down, right? Because you might say something that you did not intend to say and just came out, and it may not show your business in the right light for us. And unfortunately, sometimes you only get one shot, right? You only get one shot to prove yourself. And you got to be careful. If you're meeting someone for the first time, just do your homework. Go to their LinkedIn profile, find some people that are common with you, maybe some people that you know really well, and you could start a conversation on that, or you could start a conversation on um, something that the person last spoke about and how that resonated with you. And just getting that bit of effort makes the other investor feel, or like some feel that you actually put in the effort, right? That you actually care, and they would like to know more about you. It's a bit of a gift to get. Aditya, the right place to reach out to me would be, when you start hitting that 5 to 7 lakh rupee a month mark as a business, you got some traction. So again, I put a rupee number on it. Sometimes even non-rupee traction, but as long as it is verifiable traction, we're okay with. But when you start having some traction, you need some capital to grow. Usually, a couple of crores. That's when you reach out to me. And I know a lot of people are asking about the tech market, guys. I would, I'm not refraining from that because that doesn't really form part of the theme for tonight, which is strategies about fundraising. If there is any one last question, I'll take it, and then okay. I think Pravas is asking the last question, and he's asked some amazing questions today. So, last question for the day: what are your thoughts on strategic investors? I think they're extremely, extremely important, right? But it depends upon how much equity are you giving them, right? If the strategic starts taking 25-30% equity, it could get a bit dangerous. It could drive off your potential VCs, because strategic has way too much stake in a business. But if they have 10% equity in a business and they're like a major client, it could actually give a lot of confidence. It actually means that VC, also that strategic, is actually now going to be a locked-in customer, so that business is going to be with you, and they could really help towards product development and also making other connects. So strategic investors, definitely thumbs up. Just be careful about how much equity you impart to them, because they have it shouldn't look like you're an impending acquisition to happen, because that would definitely affect the valuations you have. So that I would say, be a bit careful about how much equity you're imparting to a strategic, but definitely a strategic is a very interesting investor to have on board. So guys, again, thank you so much. Thank you so much, people that have been tuning in for the last year. We've gone through 40 episodes together. We've learned a lot. I mean, I've learned a lot just interviewing people and taking your questions to them. And I'll be back next week, and we'll come back every single week. Would love to know if there's any particular founder you would like for us to invite. So please put names of founders you want us to invite. Maybe tag them, and we'd be happy to reach out to them for you and see if we can bring them onto our little neck of LinkedIn, Twitter, and YouTube, and hopefully get them to share their experiences with us, and we can all learn from that. So thank you once again, and looking forward to having another great year of the Money Talks. Bye bye.